Everyone is talking about the AI bubble, tech valuations, Nvidia's next earnings. That's where the next financial crisis starts, right?
An AI bubble bust. The AI bubble will possibility of an AI bubble, of course, continues to be a key focus for the markets.
Now, I hear a lot of talk about AI being essentially a bubble.
Well, just recently, the governor of the Bank of England said he's seen worrying echoes of the 2008 financial crisis. However, this comment was not about artificial intelligence, neither was it about tech stocks. You see, a company called First Brands Group had just collapsed.
First Brands files for Chapter 11 bankruptcy protection. The move comes after weeks of turmoil and might be making Wall Street nervous.
$6 billion in debt, and suddenly banks across Wall Street are rushing out to put out statements saying that their systems are safe. Barclays, HSBC, all coming out to reassure everyone, which is the exact same thing that they did in early 2008, 6 months before Lehman Brothers went under. It turns out First Brands wasn't borrowing money the normal way. They were using something called supply chain finance. And there's about $1.5 trillion of this stuff sitting in the financial system right now. Most of it is hidden, most of it unregulated. In this video, I'm going to show you how this debt machine works, why an auto parts manufacturer failing is your early warning signal, and the 3 scenarios for how this plays out over the next 18 months, because one of them looks a lot like 2008. To understand why this matters, you need to know about a CEO that spent 15 years being invisible. Now, sometime around 2010, a businessman named Patrick James starts buying up small auto parts manufacturers. Spark plugs, windshield wipers, or oil filters, the boring stuff that goes into every car but nobody thinks about. By 2020, his company, First Brands Group, is one of the largest auto parts suppliers in North America. $6 billion in annual revenue. They're supplying parts to Ford, GM, all the major manufacturers. And I'm willing to bet that you've never heard of them. Well, here's what's weird. Try Googling Patrick James. Go ahead. Actually, try it. You'll find almost nothing. No interviews, no photos. For a man running a multi-billion dollar company, there's basically no digital footprint, no LinkedIn, no conference appearances, nothing. For a company this size, that's not just unusual, that's a choice. So I started digging, and what I found were 2 lawsuits from Prisoners Business Ventures, both alleging fraudulent conduct, both quietly settled before going to trial. But here's where it gets interesting. That $6 billion company, it has $6 billion in debt, which means the entire company is basically leveraged 1 to 1. Except it's actually worse than that, because on top of the $6 billion in regular debt, First Brands had another few billion in something called off-balance sheet financing. So this is debt that doesn't show up as debt on their financial statements. So if you're thinking, well, one over-leveraged company made bad decisions, you are missing the entire point, because this isn't about First Brands. This is about how they borrowed the money and who else is borrowing the exact same way. Now, let me show you how supply chain finance actually works, because once you understand the mechanism, you'll see why this is basically everywhere right now. So here's the basic idea. First Brand orders parts from a supplier in, say, Malaysia. That supplier ships the parts, but First Brands doesn't have to pay for, 90 days. That's normal in business, right? Net 90-day payment terms. Problem is, that Malaysian supplier needs cash now. They've got their own bills to pay and they can't wait for 3 months. So a bank steps in. The bank pays the supplier immediately. Let's say they pay $1 million. The supplier gets their money today, minus a small fee, of course. And in 90 days, First Brand pays the bank back with interest. Everybody wins, right? The supplier gets paid, First Brands gets their parts, the bank makes money on the interest. Here's the trick. That $1 million that First Brand owes, it doesn't show up as debt on their balance sheet. It's classified as trade finance. It's just part of doing business. It's not a loan. Except it is a loan. It's absolutely a loan. But because of how it's structured, it gets reported differently. Now, This might sound familiar because we've seen this before. A company called Greensill Capital was doing the exact same thing. They collapsed in 2021. $10 billion just gone in a matter of weeks. You might remember that one. They were financing everything from steel to pharmaceuticals using this structure. And when it unwound, it took down a bunch of other companies with it. But Greensill was just $10 billion. The supply chain finance market today is about $1.5 trillion. And it's not just auto companies, it's manufacturing, it's retail, pharmaceuticals, construction. Any company that has suppliers and wants to smooth out their cash flow. Since 2020, this market has absolutely exploded. Companies are using it to hide debt. Banks are using it because the returns are better than traditional lending. And here's the problem. Regulators can't see inside it. There's no central reporting. There's no way to know who is exposed to what. There's no way to know if the company at the end of the supply chain can actually make the payment. Which means that when one company fails, nobody knows where the losses actually are. Now, if this is giving you 2008 vibes, well, there's a reason. You see, in 2008, banks were packaging up risky mortgages and turning them into complex securities. They were sort of slicing them up, mixing them together, and selling them to investors. And nobody really knew what was inside. Today, banks are packaging up risky invoices and turning them into complex securities. It's the same playbook using different assets. In 2008, rating agencies were giving AAA ratings to package of subprime mortgages. Everyone trusted the ratings. Well, today, supply chain finance mostly bypasses the rating agencies entirely. There are no ratings. You're just trusting that the company will pay their invoices. In 2008, when things started breaking, nobody knew who was holding the risk. Was it your bank? Was it your pension fund? It took months to figure out. Well, right now, with the supply chain finance, nobody knows who's holding the risk. And then in February, well, Trump announces new tariffs on auto parts, 25% on imports from Mexico and Canada. Now, First Brands actually got exemption for most of their Mexican operations. But here's what happened. The tariff uncertainty spooked the banks. They started looking more carefully at all their supply chain finance, the exposure in their exposure in the auto industry. And when they looked at First Brand's books, they realized something. On top of the 6 billion in regular debt, there were another 2 to 3 billion in off-balance sheet liabilities that they hadn't fully understood. So the banks panicked. When they looked at their books, they realized they had $6 billion exposed to First Brands. But it's not just First Brands, of course. They've got billions more in supply chain finance deals across the auto industry, across manufacturing. And they don't actually know which companies are in trouble until those companies stop paying. So what do? Well, they start calling all the customers, checking in, making sure everyone's okay. Which spooks those companies, and that spooks their investors. And suddenly you've got the Bank of England governor, Andrew Bailey, in front of cameras. Here's his full quote. There are some worrying echoes of the run-up to the 2008 financial crisis. Opacity in the financial system, excessive leverage in certain areas, and they believe that this time is different. Now, that last part is the key. Everyone is saying that this is in 2008. The banks have more capital now, regulations are tighter, we learned our lessons, which is exactly what everyone was saying in 2007. Bear Stearns collapsed in March 2008 and everyone said it was contained. It was just one firm. The system is fine. Well, 6 months later, Lehman Brothers went under and the entire global financial system froze. So, what does this actually mean for you? Well, let me walk you through 3 scenarios and what each one looks like. Best case, regulators move fast, new disclosure rules come in, and companies have to start reporting supply chain finance as actual debt. Some firms collapse because they can't handle the real leverage, but it's controlled. One at a time, not all at once. You are looking at some market volatility, maybe your 401k, your pension fund takes a small hit, but nothing catastrophic. The system absorbs it. Medium case, and this is probably more likely. Regulators are a bit slow, they study the problem, they form committees. Meanwhile, more companies start collapsing, banks start tightening credit across the board, and it becomes harder to get a car loan. It becomes harder to get a mortgage. Your retirement accounts drop 10, maybe 15, 20%. They're hiring freezes. And they're also higher interest rates on everything that you're trying to borrow. It's not great, but it's not 2008 either. Worst case, and this is the scenario that keeps central bankers up at night. You have a major bank that announces losses on supply chain finance that are way bigger than anyone expected. The market realizes that nobody actually knows how much of this stuff is out there or who's holding it. Credit market freeze. Banks stop lending to each other because they don't know who's exposed, and we get a 2008 style credit crunch. Job losses, retirement accounts down 20, 30, 40%. Housing market freezes. We're talking recession. Well, I don't have a crystal ball, but I think, or well, at least I hope, I'm not sure, that we're looking at somewhere between scenario 1 and 2, if this happens at all. The next year or two should hopefully tell us which way this breaks. And so while everyone is watching Bitcoin prices, tech stocks and tech earnings, and whether Bitcoin is going to, the moon, a shadow banking crisis might be quietly unfolding. It's unlikely it's going to be one dramatic weekend where a major bank just collapses. It's most likely going to look like a series of isolated failures, one company and then another, until suddenly it's not isolated anymore. Now, the comparison to 2008 isn't perfect. Banks are stronger than before and they have more capital. They can take more losses, but the opacity is worse. And that's the problem. When you can't see the risk, you can't price it. And when markets realize that they can't price risks, that's when they freeze. So here's what you should be watching. First, more first brand moments. So companies collapsing with hidden debts that nobody knew about. If you start seeing headlines about supply chain finance or trade finance in bankruptcy filings, well, that's your signal that something is wrong. Second, bank earning reports. So when major bank reports quarterly earnings, look for mentions of trade finance or supply chain finance write-downs. If they are writing out, these big losses, it means they are finding problems. And if one bank is finding problems, well, others are too. Third, regulatory announcements, particularly from the Bank of England and the Fed. If they start talking about shadow banking oversight or new disclosure requirements for supply chain finance, well, that's actually good news. It means that they're getting ahead of it. If they are silent, well, that's probably worse. The warning signs are there, and Rubeli saw them. Other central bankers are seeing them. The question is whether anyone else is watching. If you like the analysis, please hit the like button and do share the video. And if you'd like to see more analysis like this, well, click on the video suggestions that should be on your screen somewhere up there right now. Oh, and do consider subscribing. Bye.